Thanks, Michael. Lucky last, so I'll try not to keep you too long. Thank you to Michael and Leanne. Again, similar to everyone else, great venue, great event. Always fantastic to catch up with all our colleagues and peers around the industry. And also congratulations to all of today's winners. So in terms of outlook, I wanted to take a slightly different tack and talk a little bit about Australian retail. It's easy to forget that despite all the noise and gloom and doom, we actually stand up really well on the global scale. And I think, if you look at today's results and the big guns, any of those centres or any of those achievements would stand high in a global perspective. If you think about it from an investor's perspective, last year Australian retail delivered close to 8% total return, and to put that in context, against the US, it's sort of just north of 4, and the UK sub 3. So despite what we hear, and we know we've all got challenges and headwinds in the industry, we think the fundamentals around Australian retail are still really strong as a sector, and we shouldn't forget that. So as an industry, what underpins those really strong foundations? We've had the benefit of a really good, strong, stable economy. The last 15 years we've averaged something like 1.6% population growth, which is a real driver of retail sales. Put that in context against other economies, UK something like 0.5%, US something like 0.6% going forward. So, even from a broader GDP growth, whilst some of those forecasts have softened a little bit for Australia, we're still strong relative to US and UK at sub 2% forecast going forward. We've got really strong economic fundamentals. We've had 27 years without a recession, which is a record for developed economies. Total returns in Australian retail have shown less than half the volatility over the last 10 years that they have in the UK and the US. All of which really continues to undermine the world-class defensive characteristics of Australian retail as a long-term income investment. From a planning point of view, despite we might all moan and groan at times, we do actually have a pretty balanced planning policy here that balances supply and demand and makes sure that we do actually have sustainable supply, which results in our shopping centres being more productive both for our retailers and our investors. And from a retail mix point of view, you hear a lot about the US, but we shouldn't remember we're actually starting a long way ahead of the curve compared to some of those markets. When you look at regional centres in the US, historically, I think they've had something like 45% of their space dedicated to department stores and 65% of their specialty space dedicated to fashion. So we're sort of sitting at 20 to 25% and 38% by comparison in Australia. So, we're coming from a much stronger position, but, there's no doubt we still need to go through some of that repurposing of space that we're seeing in those markets as consumer demands change, and, we're adopting to the challenge and the opportunity of online retail. But that said, we can also look to some of those offshore markets to learn as well. As good as our industry is, we look to the US and that whole process of starting to repurpose space and bringing in other retail uses as well as non-retail uses around health and education and leisure and entertainment. I think, we'll start to see more of that happening through our centres here. And I think also, if you look to the US and starting to see that trend of pure play online retailers starting to come into shopping centres as they recognise the value of bricks and mortar to their own businesses. And a recent study from JLL looked at something like 100 digital native brands and their forecasts for bricks and mortar, and projecting they'd open something like 850 stores in shopping centres in the US over the next 5 years. So what does all that mean for us? I think active evolution and active management is more key than ever as we see growth in valuations slowing down. So for us, it's all about how do we focus more on driving income. At AMP Capital, we're continuing to take a bespoke approach across our portfolio because it is very diverse, and on an asset by asset basis, really looking at how do we invest in growing sales, how do we invest in customer experience as the key drivers for long-term performance for us. And that's both through our development pipeline and our portfolio of other assets. So on the development front, we've got in excess of $1 billion of projects under development, 2 in New Zealand at Botany and Bayfair that will complete later this year. We kicked off Karrinyup in WA in November, and that's going really well. And we've recently launched Marrickville Metro here in the inner west of Sydney. So, you know, when we're doing our jobs well as an industry, we still get that investor support, which is great. So in terms of other things we're doing, you know, some of that means making tough calls, and I think, you know, we're all having to do that as an industry. Last year for us, we turned over more tenants than we ever have on lease expiry, but the great news is across our portfolio, we've seen about a 45% sales increase as an average between the incoming tenants versus the outgoing tenants. So, you know, those strategies of being really active, hands-on, and modifying our product to meet the changing consumer demands is starting to get traction. So from an outlook point of view, you know, there's lots of noise, there's lots of doom and gloom. You've heard so many great stories here today. We're all doing fantastic things out around the industry, and I think it's really incumbent on all of us to get more of those out there. You know, I think, you know, we lead the world in a lot of what we do. Michael sort of touched on some of that as well. But let's all focus more on what we can do rather than what we can't. Let's get those great stories out there, and let's continue to make retail really strong. Thanks, everyone.